January 30th, 2026, 2:47 p.m. Eastern Time. Silver, $120 per ounce. Gold, $5,595 per ounce. You're watching your screen. Maybe you bought in at $80, maybe at $100. Maybe you were one of the smart ones who got in early and rode the wave all the way up. Your portfolio is up 200%, 300%, maybe more. You're thinking about that boat, that house, early retirement. 2:48 p.m. Silver drops to $115. No big deal. Just profit taking, right? Markets do this. Buy the dip, they say. 2:52 p.m. Silver, $105. 2:56 p.m. Silver, $95. 3:04 p.m. Silver, $83. In 17 minutes, silver crashed 30%. Not 30% over a week. Not 30% over a day. 30% in 17 minutes, $3.4 trillion. That's trillion with a T, gone, evaporated, in the time it takes to grab coffee and check your phone. And you know what the media told you? Investors booked profits. Kevin Warsh nomination eased Fed independence concerns. Dollar strength pressured metals. Cute. Real cute. Want to know what really happened? Buckle up. Because what you're about to learn will fundamentally change how you view financial markets. And I'm not talking conspiracy theory nonsense. I'm talking documented, prosecuted, billion-dollar fine-level market manipulation. And they did it again. Right in front of your face. January 30th wasn't a surprise. It was a repeat. December 29th, 2025, exactly 1 month earlier. Silver plunged 15.75% in a single day, wiping out $600 billion in market value. Same playbook, same script, different excuse. Let me show you something interesting about these crashes. Both happened during low liquidity periods. December 29th, holiday trading, skeleton crew at the desks. January 30th, Friday afternoon, end of the month, everyone's heading for the exits. Coincidence? Sure. And I've got a bridge in Brooklyn to sell you. But wait, let's zoom out, because this pattern goes back further than you think. April 15th, 2013, gold crashed 9% in a single day, the biggest drop in 30 years. Silver fell 11% the same day. March 2020, during the COVID panic, COMEX gold and silver futures experienced extreme dislocations, with gold futures premiums over spot reaching $70 to $80 per ounce, the largest in decades. August 2020, silver dropped 16.85% peak to trough in one session. And now, December 2025 and January 2026, two massive crashes within 32 days. This isn't random. This is clockwork. So, what was the excuse for the January 30th massacre? Kevin Warsh. President Trump announced Kevin Warsh as his pick to replace Jerome Powell as Federal Reserve Chair. Warsh is supposedly a hawk, someone who likes high interest rates. Higher rates are bad for gold and silver because they don't pay interest, so investors prefer bonds. Makes sense, right? Clear cause and effect. Markets react to news. Business as usual. Except, let's look at the timing. The Warsh announcement came at approximately 12:30 p.m. EST. Markets dipped slightly. Nothing crazy. Gold down 2%, silver down 3%. Normal reaction to news. But the real carnage, that didn't start until 2:30 p.m. 2 full hours later, from 12:30 to 2:30, prices actually recovered a bit. Traders digested the news, decided it wasn't that bad. Then at 2:30 p.m., like someone flipped a switch, the bottom fell out. Silver plunged from $112 to $75 in less than 3 hours. Gold went from $5,400 to $4,718. And here, S beautiful, the word they don't want you to focus on, futures. This crash happened primarily in COMEX futures and paper silver contracts, not in physical metal. Let me explain why that matters, because this is where the con lives. There are two silver markets, two completely different markets that claim to trade the same thing. Market number 1, physical silver, actual metal, bars, coins, bullion, the stuff you can hold in your hand, supply and demand. Economics 101. Market number 2, paper silver, futures contracts, ETFs, derivatives, promises of silver, IOUs, digital entries in a database. And here, the kicker. Paper silver trades at a ratio to physical silver of somewhere between 50:1 and 400:1. Read that again. For every 1 ounce of actual deliverable silver, there are 50 to 400 ounces of paper claims on silver being traded. Daily COMEX silver futures trading volume regularly exceeds 150,000 contracts, with each contract representing 5,000 troy ounces. That's approximately 750 million ounces traded daily on paper. Global silver mine production in 2023 was approximately 830 million ounces for the entire year. So in one day, more paper silver trades than an entire year of global mining production. In a week, paper trading exceeds 5 years of actual mining. Think about that. The market trades more silver in 5 days than physically exists. From 5 years of digging it out of the ground, it's a house of cards. A beautifully engineered house of cards that lets a handful of traders with big enough computers crash the price of silver without touching an ounce of real metal. And on January 30th, they pulled that lever hard. Here's how it works. Leverage. Most futures traders don't buy contracts with cash. They use margin, borrowed money. When prices drop suddenly, their broker demands more cash to cover the position. If they can't post the cash, automatic liquidation, which creates more selling, which drops the price further, which triggers more margin calls, which forces more liquidation. It's a cascading waterfall of forced selling. And if you time it right, during low liquidity with a convenient news hook, you can crash a market. While the physical metal, still sitting in vaults, unchanged. Supply didn't increase. Demand didn't vanish. But the price, that magical number on your screen, that number is whatever the paper market says it is. And this is where it gets truly sinister. Because this isn't theoretical. It's not speculation. We know this happens because they've been caught, prosecuted, convicted, and they're still doing it. Let me introduce you to some criminals. Convicted, sentenced, prison time serving criminals. Michael Novak, head of JPMorgan's Global Precious Metals Desk, convicted in August 2022 on charges of spoofing, conspiracy, and wire fraud. Sentenced to 1 year and 1 day in prison, plus a $35,000 fine. Greg Smith, executive director at JPMorgan, convicted on the same charges. Sentenced to 2 years in prison, plus a $50,000 fine. Their crime, manipulating gold and silver futures markets through thousands of spoofing acts over an 8-year period from 2008 to 2016. And JP Morgan, the bank itself, paid $920 million in fines to settle charges related to precious metals manipulation. $920 million. You don't pay nearly $1 billion in fines for a misunderstanding. But wait, there's more. Because JP Morgan wasn't alone. Deutsche Bank, $38 million settlement for silver price manipulation 2016. Scotiabank, $360 plus million total cost, forced to exit the business 2022-2021 UBS, HSBC, Barclays, and others. Various settlements totaling over $1.3 billion, 8 major banks. $1.3 billion in regulatory fines. Multiple criminal convictions. All for manipulating precious metals markets between 2008 and 2016. And you know what's hilarious? The prosecutions concluded in 2020 to 2025. 4 crimes committed 2008 to 2016. So, what happened in 2024 to 2025? Silver rallied 260% to $83 per ounce, then crashed twice, because apparently they learned their lesson. Oh wait, let me explain spoofing, because this is the heart of the scam. Imagine you're a big bank. You want to buy silver cheap, but if you just place a giant buy order, the price will shoot up before you can fill your order. That's how markets work. Big demand pushes prices up. So instead, you do this. Step 1. Place massive sell orders. Thousands of contracts. Way more than you actually want to sell. Step 2. Other traders see these giant sell orders. They think, oh crap, someone knows something. Big selling pressure incoming. Better sell before the crash. Step 3. These other traders panics. Price drops. Step 4. You cancel your fake sell orders. You never intended to sell. You just wanted to create the illusion of selling pressure. Step 5. Now the price is lower. You place your real buy orders at the artificially depressed price. Step 6. Profit. The JP Morgan traders did this thousands of times. Not occasionally, not when desperate, thousands of times. The documented case revealed sophisticated methodologies where traders placed large sell orders in COMEX gold futures contracts, rapidly canceled these orders within milliseconds, then executed legitimate purchases at artificially depressed prices. Milliseconds, they were gaming the system, at the speed of light, using algorithms and high-frequency trading to create fake market signals, trigger algorithmic responses from other traders, and profit from the chaos. And the CFTC, the Commodity Futures Trading Commission, the regulators who are supposed to prevent this, they knew, they caught them, they prosecuted them. But here's the thing about fines. They readjust the cost of doing business. When you're remaking billions, all of this happens on COMEX, the commodity exchange owned by CME Group. This is where precious metals futures are traded. The CME Group states that COMEX executes more than 400,000 futures and options contracts daily. That's a lot of trading, a lot of liquidity, a lot of opportunity for, let's call it, creative pricing here. The beautiful part of the COMEX system. Less than 1% of contracts result in physical delivery. Think about that. 99% of the people trading silver futures never touch actual silver. They're just gambling on price movements. It's a casino where the chips are claims on metal that will never be delivered. And because delivery almost never happens, the price is completely disconnected from physical reality. Let me give you some numbers that should make your head spin. Current COMEX data shows approximately 500,000 to 650,000 contracts in open interest, representing 50 to 65 million ounces of potential gold demand. However, registered deliverable gold in COMEX vaults typically maintains only 1.5 to 2 million ounces. That's a coverage ratio of approximately 3 to 4%. They have promises for 50 to 65 million ounces, backed by 1.5 to 2 million actual ounces. For silver, it's even worse. Commercial traders currently hold short positions, equivalent to approximately 60 billion ounces in COMEX futures contracts. Global silver production, about 850 million ounces annually, they've sold 60 billion ounces of paper silver. That's 70 years worth of global production. 70 years. And you want to know the truly criminal part? This is all legal. Perfectly. Completely legal. As long as you don't get caught spoofing. So let's connect the dots on what happened in December and January. Throughout 2025, silver had been on an absolute tear, up 135% for the year. Gold, up 66%, both hitting all-time highs. Retail investors piling in through ETFs, meme stock energy, Reddit forums lighting up with silver squeeze talk. Physical demand was crushing supply. The silver market had run a supply deficit for 5 consecutive years. Industry estimates suggest cumulative shortfalls of roughly 820 million ounces between 2021 and 2025, nearly equivalent to a full year of mine production. On COMEX, silver futures were falling into backwardation, where near-term contracts cost more than future contracts. This is huge. Backwardation means immediate silver is more valuable than silver promised for later. It means we're not sure there will be enough silver to deliver. The LBMA London Bullion Market Association was experiencing critical inventory depletion. After India purchased 21 to 31 million ounces in September 2025, the LBMA's available float was exhausted. Emergency shipments had to be initiated, 58 million ounces from COMEX in October alone, plus significant quantities from Switzerland and Shanghai. The squeeze was on. Physical silver was disappearing. Premiums on physical metal were spiking $10 to $60 per ounce above the COMEX price. The paper market and physical market were completely decoupled. This is a nightmare scenario for the banks holding massive short positions. Because if people start demanding delivery, if even 10% of contract holders say, "I want my silver," the whole game collapses. There isn't enough silver to deliver. So what do? You crash the paper price. You make it look like the rally is over. You shake out the weak hands, the retail investors, the newcomers who bought high and panic sell on the first big drop. December 29th, first crash, 15.75% in one day. $600 billion evaporated. Message sent, the party's over. Get out while you can, January 30th, second crash, 30% intraday. Another $3.4 trillion gone, message reinforced, we told you, silver's crashing, sell now or lose everything. And both times, they had convenient excuses. December 29th, profit-taking after parabolic move. January 30, Kevin Warsh Fed nomination. But here's what actually happened in the trading data. The crashes occurred during low-volume, low-liquidity periods. Margin requirements were suddenly tightened just before the crashes, forcing traders to either post more cash or liquidate. Large sell orders hit the market in coordinated waves. Algorithms kicked in, triggering stop losses and creating cascading liquidations. It's the exact same pattern as the documented spoofing cases. The only difference, this time they learned to hide it better. Use legitimate news as cover. Time it perfectly. Make it look like market forces. But the result is the same. Artificial price suppression. Retail investors wiped out banks, covering their short positions at artificially low prices. It was scripted. Every single move. And the question you should be asking isn't, did they manipulate the market? The question is, why did they have to? Remember our previous video about China's gold strategy? About the BRICS unit? About de-dollarization? Let me connect those dots for you. Gold and silver aren't just commodities. They're the truth serum of currency markets. When gold and silver prices spike, they're telling you something very specific. Your paper money is losing value. Throughout 2025, as gold hit $5,600 and silver touched $120, they were screaming a message the Federal Reserve did UNT want you to hear. The dollar is in trouble. The US dollar's share of global currency reserves fell to 57.7% in the first quarter of 2025, continuing a multi-year downward trend, down from over 70% at its peak. Meanwhile, gold's percentage of global international reserves jumped up 4% to 21% in 2024. The biggest surge in more than 4 decades, central banks worldwide were dumping dollars and buying gold at record pace. That's not speculation, that's documented fact. Over 1,000 tons of gold purchased by central banks per year for 3 consecutive years. And silver's the people's gold. It's accessible, affordable. Retail investors were piling in. The silver squeeze movement was gaining traction. Physical demand was overwhelming supply. This is a nightmare for the dollar-based financial system, because if gold and silver keep going up, they reveal the truth. The emperor has no clothes. The dollar is backed by nothing but promises and military bases. The U.S. national deficit has reached approximately $38 trillion. The government is spending $175 billion on foreign conflicts while running a 7% GDP deficit. The only reason this works is because the world still wants dollars. But what happens when the world prefers gold? The January 30th crash wasn't just about Kevin Warsh, it was about sending a message. Look at what else crashed that day. Bitcoin, down 15%. Tech stocks, down sharply. Risk assets across the board got hammered, but precious metals, they got absolutely decimated. Silver down 30%, gold down 8 to 16% at worst, the most violent moves in decades. This wasn't investors booking profits from gold to buy stocks. Everything went down. It was a coordinated de-risking event, and I do mean coordinated. Because here's what's interesting. The crash happened in COMEX futures, paper contracts. Meanwhile, physical silver and gold, premiums actually increased during the crash. While COMEX silver was trading at $70 to $73 per ounce, physical silver prices were $10 to $60 higher depending on the market. Dealers couldn't keep inventory. Wait times for delivery stretched 2 weeks. The crash only existed on paper. The physical market was saying, "We don't believe you. Silver is still valuable. We're not selling." Keith Neumeyer of First Majestic Silver Corp noted that the September-October 2025 period was their biggest sales month of all time for physical bullion. Despite the paper price crashing, people were buying physical metal like crazy. This is what's called a disconnect. And disconnects don't last forever. So let's talk about Kevin Warsh, the convenient excuse for the crash. Warsh is supposedly a hawk, someone who wants higher interest rates to fight inflation. Higher rates make bonds more attractive than gold, since gold doesn't pay interest. Fine, makes sense. Except gold has historically performed well during rate hike cycles when real inflation is high. In the 1970s, rates went up, and gold went from $35 to $850, because the rates weren't high enough to beat inflation. Right now, with inflation running 3.2 to 3.5%, even if the Fed raises rates to 5%, that's still negative real yields. Gold should thrive in that environment. Plus, Warsh hasn't even been confirmed yet. He hasn't made a single policy decision. Markets were supposed to crash on speculation about what he might do at some unknown future date. Please, and remember the timing. Announcement at 12:30 p.m. Prices dipped slightly, then recovered. The real crash didn't start until 2:30 p.m., 2 hours later. If this was really about Warsh, the crash would have been immediate. Instead, it came during the afternoon lull, when liquidity dries up and big orders have maximum impact. It's textbook manipulation timing. Use the news as cover, but execute the crash during optimal conditions for maximum price impact with minimum actual selling. And it worked beautifully. The media ran with the Warsh narrative. Retail investors believed it. Panic selling ensued. Banks covered shorts at bargain prices. Meanwhile, anyone paying attention to the physical market knew nothing fundamentally changed. Supply is still tight, demand is still strong. The only thing that changed was the paper price. Here's what I think is really happening, and I'm not alone in this assessment. The dollar-based financial system is under attack, not from terrorists or foreign armies, from mathematics, from economics, from the simple fact that you can't print infinite money without consequences. BRICS nations launched a gold-backed currency pilot. China is sitting on 5,000 tons of gold. Central banks are buying precious metals at record pace. The petrodollar is dying as EVs kill oil demand. The system is cracking, and gold and silver prices rising to record highs advertise those cracks to everyone with a smartphone. So what do? You can't stop the underlying forces. You can't make people forget about gold. You can't magic away the debt. But you can control the price, temporarily through paper markets, through futures manipulation, through coordinated crashes that scare retail investors and make precious metals look risky and volatile. You make gold and silver look like speculative bubbles instead of monetary alternatives. You make people think, oh, that rally was just mania. Good thing I didn't buy that. I'll stick with my dollars and stocks. It's psychological warfare, financial PSOPs, and it works because most people don't understand the difference between paper and physical markets. They see the price crash and assume silver is worthless. Meanwhile, the smart money, the central banks, the ultra-wealthy, they're buying physical metal hand over fist because they know the paper price is fake. They know the crashes are engineered. And here's the tell. After both crashes, the price recovered partially. December crash, silver bounced from $65 to $80. January crash, silver bounced from $75 to $95 plus. Gold, similar pattern, because the fundamentals didn't change. The supply deficit didn't magically fix itself. The dollar didn't suddenly become sound money. All that changed was some algorithms dumped some paper contracts during low liquidity and shook out some weak hands. And now we come to the endgame, the trap they've set for themselves. See, every time they crash the paper price, they widen the gap with physical prices. They make the disconnect more obvious. They create more skepticism about the paper market. Eventually, and nobody knows when, that skepticism reaches critical mass. Enough people demand physical delivery. Enough people refuse to sell physical metal at paper prices. Enough people realize the scam. This has happened before. In 1971, when too many countries wanted to redeem dollars for gold, Nixon had to close the gold window. Game over for the gold standard. In 1980, when the Hunt brothers tried to corner the silver market, they nearly succeeded until the COMEX literally changed the rules mid-game to stop them. Visual rule changes, historical precedent, the system survives by changing the rules when threatened. But each time they do it, they lose credibility. They expose the manipulation. They create more believers in physical precious metals. And this time might be different. Because this time, it's not just speculators or wealthy families. It's central banks. It's entire nations. It's BRICS representing 40% of global population and 31.5% of GDP. You can't change the rules on China. You can't call up India and say, sorry, no delivery. You can't margin call a sovereign nation. The paper market works as long as everyone plays along. As long as people accept paper claims as equivalent to physical metal, as long as nobody calls the bluff. But bluffs, by definition, can be called. Analysts are already warning. If physical shortages persist, pressure may eventually build for prices to reflect underlying fundamentals more accurately. Translation: the paper price will have to catch up to physical reality. And when that happens, when the COMEX runs out of deliverable metal, when the LBMA admits they can't fulfill contracts, when the gap between paper and physical becomes impossible to ignore, the crashes won't matter anymore. The manipulation won't work. The script will be torn up. Because at the end of the day, you can't manipulate physical scarcity. You can't print silver. You can't QE gold into existence. And that's why they're so desperate to crash the price now, while they still can, before too many people figure it out. So what do you do with this information? First, understand the game. Paper and physical are two different markets. The paper market sets the price, but can be manipulated. The physical market reflects actual supply and demand. If you're buying precious metals as insurance, as protection against currency devaluation by physical coins, bars, bullion, stuff you can hold, yes, you'll pay premiums above the COMEX price. That premium is the fee for reality. ETFs like SLV and GLD, their paper, the prospectus explicitly states only authorized participants can redeem for physical metal. You, the retail investor, cannot. You're just betting on price movements. That's fine if you're trading. But if you're hedging against systemic risk, paper won't save you when the system breaks. Second, understand volatility is the price of admission. They will crash the paper price repeatedly. It's part of the script. If you panic sell during these crashes, you're doing exactly what they want. Dollar cost average. Buy consistently over time, smooth out the volatility. Take advantage of the engineered dips. Third, watch the physical market, not the paper price. If premiums stay high during crashes, if delivery times extend, if dealers can't keep inventory, those are signs the paper price is fake. Between 2020 and 2024, central banks of BRICS member states purchased more than 50% of global gold. They're not buying paper, they're buying physical. Follow the smart money. Want to know when the endgame is approaching? Watch these indicators. Backwardation depth. When near-term futures consistently trade above long-term futures, it signals physical scarcity. The deeper and longer the backwardation, the worse the shortage. COM inventory levels, registered deliverable silver and gold in COMEX vaults. If this drops below 5% of open interest, delivery crisis incoming. Physical premiums, the gap between COMEX prices and actual dealer prices for physical metal, widening premiums equals paper-physical disconnect growing. Central bank buying. If central banks accelerate gold purchases despite high prices, they know something. They're preparing for something. Delivery delays. Time from purchase to physical delivery. Delays stretching from days to weeks to months equals supply chain stress. As of now, backwardation is appearing in silver. COM inventories are at multi-year lows relative to open interest. Physical premiums spiked during both crashes. Central banks keep buying. Delivery delays are extending. Every indicator is flashing warning signs. The crashes are symptoms, not solutions. Here's what I want you to understand. This video isn't about telling you to buy gold and silver. I'm not a financial advisor. I don't sell precious metals. I have no dog in this fight except truth. What I'm telling you is that the markets you think are free aren't free. The prices you think are real aren't real. The system you think is solid is riddled with fraud and manipulation. They've been caught, prosecuted, fined billions. And they're still doing it. Because the alternative, letting gold and silver rise to their true value, is an admission that the dollar is dying, and they can't admit that. Not yet. So they manipulate, they crash, they shake out the retail investors and cover their positions and reset the game board. But here's the thing about manipulated markets. They eventually break. The manipulation becomes too obvious. The disconnect becomes too large. The liars run out of believable lies. We might be approaching that breaking point. The December and January crashes might be the last gasps of a dying system trying to maintain control. Or maybe they can keep this going for years. Crash after crash, excuse after excuse. Who knows? But either way, the script has been revealed. You've seen how the magic trick works. The question is what you do with that knowledge. Because the one thing I know for certain is this. They scripted the crashes. They manipulated the prices. They stole trillions from unsuspecting investors. And they'll do it again.